Saurabh Mukherjea, founder of Marcellus Investment Managers, is joining us right now. Saurabh, very good morning to you, and great to have you on a day where we actually made a new record high. But do things change materially from here? Or this is just, one more level that we have crossed, one more hurdle that we have crossed. Though obviously on ground we've not really seen a big change in fundamentals as such.
I think, look, this is familiar territory for India insofar as if you look at our stock market's history, 80% of the gains in the stock market have come in the 2 years following general elections. So in the 2 years following general elections, if you take the last 10 general elections, in the 2 years following elections, the stock market's given on average 27% per annum compared to the long-term average of 14 odd percent. So nearly double the returns in the years following general elections. And the reason this happens is also very familiar. This reason this happens, typically economic reforms come in the aftermath of elections. The stock market discounts the benefits of the economic reforms. The stock market rallies a good 1 to 2 years before the economy picks up. So very familiar territory for India. We were here in the early 80s, we were here in the early 90s, and once again, as we approach the end of 2019 and we approach the beginning of a new decade, we are finding ourselves in territory where the stock market is discounting economic reforms before the economic growth actually begins.
So what's your advice now, Saurabh? How do we tread these markets? What's happening on ground, economic indicators completely divergent from what the equity markets are doing right now. And probably I would read it as a silver lining that we've reached these record highs without any support from foreign institutional investors who still in the derivatives market are, short. They're covering their short, but there's still some time to go now. Would you say that leaves a lot more headroom for foreign investors to come in and propel the markets even higher?
So I wouldn't really worry about whether foreign investors come or don't come. I think the way money has been made in India over the last 30 years is extremely clear now. And I think we just carry on doing that. Your viewers can carry on doing that. Nobody out there, myself included, can suddenly become overnight an economic expert and second guess which quarter, which month the economic recovery will begin. I don't think that's a practical, feasible exercise. What we can all do is identify companies which have clean numbers, fabulous franchises, long track records of making lots of money for investors. Those stocks are out there. We go and buy them. And as we've discussed before, people who look at PE and try to make investment decisions, typically struggle in India because you're constantly second guessing the PE multiple, which is not a clever way to invest in our country. But on the other hand, identifying great franchises, clean numbers, high barriers to entry, very doable exercise. Your viewers can do that and buy those stocks and hold your nerve through what is clearly a very difficult economic climate. Hold your nerve, buy these high quality names. Indian history shows you'll make healthy returns even if the economy takes longer to recover than anybody expects.
Saurabh, good morning, and well, to all bulls out there, congratulations, and you guys are managing a lot of people money, so good for you as well. The question is, at times of excitement, does it help to buckle down and be boring? Because we were speaking to Rakshit a few days back, and he said that we love being boring in these markets as well because that is what is making money.
I think in all times, whether it's exciting times or fearful times, it pays rich dividends to be boring in India, because this is an economy, this is a polity which generates enormous amounts of risk. Our political system, our regulatory system generates enormous risk for investors out there. Our economy is still a underdeveloped economy. A per capita income at $2,000 per capita is lower than most sub-Saharan African countries. We are a poor country. If in a poor country with a volatile polity, you go out there and take risk, it's very difficult to make money. On the other hand, you compress risk. You don't take balance sheet risk, you don't take franchise risk, you compress risk, you make very, very healthy returns in our country. That's been our motto for ourselves, for our clients, and it works. It works not just for making money. Making money is incidental, actually. It works in terms of keeping our nerves and our clients' nerves in check. You try to take risk in the Indian market. I think I remember telling you guys in an interview 2 or 3 months ago, you try to take risk in the Indian market, you're typically carried out in a stretcher.
Saurabh, does the approach to building the portfolio change now? throughout our conversations in the past, we've spoken about financials, we've spoken about consumption stocks, stocks which are catering to essentials for the mass of India. Does that change? Do you want to build in a little more risk into the portfolio?
No, not really. I mean, I think we've got to remember what is the nature of the economic reform process we find ourselves. And I think the nature of the economic reform process in India over the last 3 years, around GST, around demon, around the recent corporate tax rate cuts, all of this is suggesting that the entire economy will get concentrated into the hands of a few market leaders. By market leaders, I mean economic market leaders, not stock market leaders. So if you are Asian Paints, these reforms are incredibly positive. The entire informal paint industry is going to fold up and you're going to be a massive beneficiary of that. Ditto for Pidilite in adhesives, ditto for someone like Relaxo in footwear, right? So the entire thrust of the current bout of reforms that we've seen from the NDA over the last 2 to 3 years is suggestive of economic power being concentrated into the hands of a few large companies. They benefit big time from this process, and it therefore behooves us to invest our clients' money in such companies. Now, such companies they could also be in B2B. They don't necessarily have to be just consumption plays. And our job is to find such B2B companies as well. I think we found a couple. We're looking for a couple more. And I think that's the only change we'll make. We've now, it's now relatively clear how the NDA wants to change the country. It's taken us 6-7 years to completely figure it out. But now that it's relatively clear how the NDA wants to change India, it behooves us to look for companies, not just in B2C, but also in B2B, who will become sector dominators, crush the smaller players in the sector, and build very lucrative, very profitable franchises.
Saurabh, we're looking at some data points, and the percentages and the points might be a bit different, but when you look at companies which have largely done well from the last time we hit the highs, which is on June 3rd until now, at the mid-cap 100, the likes of Info-Edge, Voltas, Berger, Tata Global, Jubilant FoodWorks, all of them distinct flavor of consumption. At the large cap arena as well, you have financials largely and Reliance Industries and maybe to an extent HUL. The classic adage is that the leaders of the previous rally don't necessarily lead the next rally. With the presumption that over the next 2 years we will be higher from where we are right now, would you believe that the set of leaders will change, or would you believe the same old will continue to move higher because the earnings momentum and the valuation uptick in some of those is not done yet?
So there are lots of grandmother stories around which the Bombay stock market sort of hinges and tells people in the market tell each other stories around these sorts of things that leaders of the previous rally won't be. But if you look at HDFC Bank, 270x up or 280x up since 1995. I think we've had the late 90s rally, the noughties rally. Now then we had the post Modi rally. Now we're having, I guess, the post Nirmala Sitharaman rally, if you want to call it that. In every single rally, HDFC Bank has made bucket loads of money. HDFC Bank, the 2-year CAGR in the years following general elections, the 2-year CAGR for HDFC Bank is 52%. So I don't know which rally we should refer to, but every single rally I can find in history, HDFC Bank has made buckets of money. Similarly for Asian Paints. Asian Paints' PE multiple 20 years ago is what it is today. In this intervening 20 years, this company has made the best part of 100 times for investors. So we can keep, trying to figure out when will the capex cycle start, which capex play should I build on, when will the economic recovery start, which high beta play can I build on. Those are, interesting intellectual exercises to indulge in. But in terms of making money, I think the message from history is loud and clear. The 2 years following stock markets is when the bulk of the money is made in the Indian market in generality, and especially in the case of high quality compounders, such as Asian Paints, such as HDFC Banks, the 2 years following stock markets tend to be extremely fruitful. I'll put it another way. I haven't found a single 2-year period following general elections in which money has been lost in India, barring one. The dot-com bust was the only 2-year period following general elections in which money was lost. So typically the Indian market long-term returns are 14-15%. In the 2 years following elections, the returns are 27%. these sorts of consistent compounders, Asian Paints, HDFC Bank, disproportionately participate in such rallies. High beta names, wax and wane, very difficult to time them, very difficult to second guess them.
Saurabh, get your point, but if only investing was all that simple, we'd all be sitting on truckloads of money right now. It's still difficult.
It is. So it's one of the things our profession does. Our profession deliberately characterizes investing as being some incredibly difficult dark art, so that we can convince people out there that you need to give us your money because it's incredibly difficult. Actually, investing, high quality investing is relatively simple, and hence the book, hence Coffee Can Investing as a book. We try to simplify it for people so that hardworking people out there who are watching this program can take their money, read Coffee Can Investing, and responsibly, cautiously, conservatively save, invest money for the long run and enrich themselves. It is no great science to invest cautiously, conservatively, and make healthy returns in what is still a poor economy with plenty of growth potential.
Okay. So just let me talk on behalf of an investor who's probably not got 50 lakh rupees to invest in a Marcellus right now. So someone who's probably looking at making and forming a portfolio for themselves.
Absolutely, yeah.
It's a question that keeps coming time and again. While savvy investors like yourself have spotted those value generators, it's difficult for a retail investor to put money in an Asian Paints when it's priced the way it's priced, or an HDFC Bank saying, "Oh, काफी भाग चुका है अभी, let's just give it a break, let's see it come down a bit and then I'll invest." So is that the area where they miss out?
Right. So I think what does happen is, although we've written Coffee Can Investing, it's easily available. People buy it on the internet. It's available in bookshops. It's not very expensive to buy, and people don't have to come and give Marcellus money. You can read Coffee Can Investing. You're right. What happens is, investors read our book. Retail investors read our book. Then they look at the newspaper and they read, "Oh my God, Asian Paints has run up and HDFC Bank has run up. What do? Let me buy some third-rate high beta name recommended by the local broker." 6 months down, that third-rate name is down 40%, and the investor loses heart, and he ends up running away from the stock market. That cycle is devastating for retail investors. They shy away from the HDFC Bank, Asian Paints type names because the PE multiple looks optically high. The broker discourages them from investing in it. They go towards the speculative names that the brokerage community loves pushing. They lose money there. They run away from the stock market into the false safety of fixed income products, and then over time their wealth compounding falls behind their aspirations, and before they know it, they're 65 years old and they simply haven't got a large enough corpus to retire on. That cycle is devastating, and you're absolutely right. All of us, whether we're in the media or we're in the financial services profession, we need to do what we can to inculcate the right savings habit in people, that buy high quality, well-run companies, invest in them through 10, 20 years of your working life. You'll retire with a handsome retirement pot. You'll retire with a hefty retirement pot.